Well, hey there, it's Terry Sawchuk. It is Thursday, so it's time for 3-Minute Thursdays. I just want to take a few minutes here today and update the market data because a lot has changed really in a week. So let's just start with the NASDAQ. You can see that this is on a 1-hour chart, so let me switch this to a daily chart and you can see what a significant difference that there is in just a relatively short period of time. So not that long ago, the NASDAQ was at 20,500, and in a few short days, now we're down to 19,000, okay? And it looks to me like it at least wants to get down to the 18,250, 18,500 range. So it looks like there's still some downside here. We'll see, but I think that's the level that it probably wants to get to. On the S&P 500, we've kind of breached a little bit this lower end of the support channel. The next stop, from I guess a volume standpoint would be around 5,200. I don't know that we'll get that low, but it's certainly a possibility. We've been due for a correction. The Fed's going to meet next week, and I think that's going to be really important. Right now, I would say it doesn't look like the Fed's necessarily going to cut next week in July. However, if the market keeps falling, it's a distinct possibility, okay? And if you look at interest rates, and this is a big driver, okay, so the dollar has definitely started to fall, and that's in line with people that expect the Fed to start cutting rates. What's more interesting is the Japanese yen. So this is the inverse. So basically the yen has gone from the dollar against the yen has gone from 161, almost 162, now down to what looks like about 154, okay, and really dropping actually. And this is where I think the big driver of what's going on in the markets right now is coming from. Google missed earnings, Tesla missed earnings, Ford missed earnings, UPS missed earnings. And so another concern here is that the economy is definitely starting to slow down. And I don't think we're on the doorstep of a recession necessarily, but we are going to see a slowdown, and it could turn into a recession. And so this is a kind of a tightrope the Fed has to walk now, because they still have inflation that's a little higher than what they want, but they've definitely got an economy that's slowing down. Now, I think this is going to be potentially a buy the dip scenario, but let me be crystal clear, that's not a foregone conclusion. So we're really comfortable with the hedges that we have in place because we've got a lot of downside protection, and if the market continues to fall a lot, we're still going to be in really good shape. We have limited exposure to the NASDAQ. We have more exposure to international stocks, S&P 500 and Russell 2000, which I think are better positioned than NASDAQ right now because it's the tech stocks that have really sold off. So with that said, we like short-term treasuries. So anything 5 years or under looks good. Gold is getting wrecked today, but I still think that gold's probably a better trade if the dollar continues to weaken. So rest assured, we're watching things closely, and a lot going on right now, though. So keep your eye on the ball and keep your inbox open and look for our email next week when we do our next 3-Minute Thursday.